In this video, we discuss what rich people know about 401ks that many of you, maybe even most of you, don't know. Coming up next on Holy Schmidt.
Holy Schmidt!
Over the year, the 401k has evolved. Loopholes have been discovered by those in the know, and those in the know exploit these loopholes for a better outcome for themselves. And that is what this video is all about. By the way, anyone can use the information in this video. You don't need to have a lot of money. Some of them require no excess income at all. You can apply them to your current situation. Others require a bit more money, and with that excess money, you can do some things that you couldn't do before. And if you're the type of person who fully contributes to your 401k, it's that second group that will be most important to you. All right, let's get into it. Number one, the mega Roth conversion. This is a special way to put extra money into a Roth account, beyond what's limited by the IRS. Roth accounts are awesome because when you withdraw the money, you withdraw the proceeds tax-free. You can spend all of it. You don't need to give part of it to the government. The Mega Roth strategy allows you to put $43,500 per year into a Roth account, if you have that much money to put into a Roth account. Here's what you need: a 401k that allows after-tax contributions and in-service withdrawals. First, you max out your regular 401k contribution. This is the one that you take the tax deduction on from your compensation. Then you contribute additional after-tax money to your 401k, and then very quickly take that additional contribution and redirect it into a Roth account. This works even if you earn too much to contribute to a regular Roth IRA. This is how wealthy people contribute to tax-free accounts. Not all employers have the right kind of 401k for this strategy, but if they do, it is gold for your retirement savings. So ask your HR department if your 401k allows for after-tax contributions and in-service distributions. Number two, this applies to everybody, and that is regular rebalancing of your investments. One only need to look at what's been going on in the market to know exactly what I'm talking about. The wealthy actively check and rebalance their investments regularly, at least once a quarter. Rebalancing means adjusting your investments back to their original target mix. For example, if your target mix was 60% equities and 40% bonds, fixed income, and that has changed, well, rebalancing means that you sell one and you buy the other. They rebalance typically when their accounts have shifted more than 5 to 10% of the original targets. This forces you to automatically buy low and sell high, by the way. You sell the investments that have grown too much and you buy the ones that are cheaper. Without rebalancing, your portfolio can become too risky or too conservative over time. This is especially important as you get closer to retirement. Many 401k plans offer automatic rebalancing services, or you can simply put a calendar notification in your calendar and check it once a quarter to see how you're doing. Strategy number three, Rule 72T withdrawals. Again, this applies to everybody, not just those with a lot of money in their 401k. If you want to retire early, Rule 72T might just be the way to go. This special rule allows you to take money out of your 401k before age 59 and a half. You can do this without paying the usual 10% penalty if you follow certain steps. With Rule 72T, you can take substantially equal periodic payments based on your life expectancy. And you must use one of three specific IRS calculation methods. And once you start, you have to continue for the greater of 5 years or until you're 59 and a half. By the way, you still pay regular income tax on your withdrawals. You just don't pay a 10% penalty on top of the income tax. This strategy works great for early retirees who need the income before the traditional retirement age of 59 and a half. But it requires careful planning because changes to the payment schedule will trigger a 10% penalty. With this one, I do recommend that you talk to a financial planner before you execute a Rule 72 strategy. That way you can construct the right distribution for your specific situation. Gang, if you're worried about healthcare and retirement, I wrote a free report specifically for you. It's called Healthcare Options in Retirement. It's completely free. It's my free gift to you. All you need to do is go to holyschmidt.com/free report and you can download it instantly. Strategy number four, watching your expense ratios. The wealthy pay close attention to something that other people overlook, and that's the expense ratio in their portfolio. Expense ratios are the yearly fees that funds charge to manage your money, and they typically are 0.5% up to 1% or more in some circumstances. These fees might seem small, but they make a massive difference over a 10, 20, or 30-year period. With an average portfolio, a fee of just 0.5% can mean $100,000 less in your portfolio at the end of 30 years. Wealthy people look for expense ratios less than 0.2% for an index fund and 0.5% for an actively managed fund. And the tricky part is that you actually never receive a bill for the expense ratio. It's just taken out of your account, and you don't know that it was taken out of your account in most cases. And just for completeness, low-cost index funds have a much lower expense ratio than actively managed funds in most cases. And they often perform just as well or better than the actively managed funds. So check your current 401k investments and ask the question, how much am I paying in management fees to the fund company? If you're paying more than, say, 0.5%, see if they offer a low-cost alternative. The savings could save you thousands of dollars over the years ahead. Strategy number 5, after-tax contributions to your 401k. In 2025, the standard limit is $23,500, and those 50 to 59 can add an additional $7,500 on top of that with pre-tax income. However, in 2025, the IRS allows up to $70,000 total contribution to a 401k, so the difference between the numbers that we just talked about and the numbers that you can contribute are based on an employer match and after-tax dollar contribution. But just to point out here, unlike a Roth, the excess contributions that you put into your 401k, the earnings on those contributions, after-tax contributions, are taxable. Of course, the original contribution is just a return of your investment because it's made with after-tax dollars, so that's just given back to you, but the earnings you do pay tax on. And by the way, this is why wealthy people often convert that excess to a Roth, because if you're putting in after-tax dollars anyway, why wouldn't you want to take it out without paying taxes on the growth? But of course, your ability to do that really depends on your plan rules. So again, talk to your HR department. Number 6, tax-smart withdrawals. In other words, taking money out from your different accounts in the most tax-efficient way. Smart retirees follow a specific withdrawal sequence to minimize their tax bill. A general rule that works well for many people is take money from your taxable accounts first, like a brokerage account or a bank account. Next, take money from your deferred account, like a 401k, and finally, take money from your Roth account. This strategy allows your Roth accounts to continue growing tax-free for as long as possible. Wealthy retirees also carefully manage withdrawals to stay in the lowest tax bracket possible. Sometimes they just take enough from tax-deferred accounts to fill up the tax bracket and not a dollar more. And they coordinate withdrawals with Social Security benefits. This helps retirement account distributions from inadvertently causing a tax on Social Security, or at least keeping that tax to the least amount possible. Planning your withdrawal strategy before you retire can add years to how long your money actually lasts in retirement. Next, they continue to invest during market drops. The best time to buy a stock or any asset is when the price is lower. But people, due to fear, start making decisions about what to do with their money, which means not putting it into the market when the market is falling. The wealthy actually do just the opposite. When they see the market falling, they look at that as a great buying opportunity. They continue to follow their investment strategy, good market or bad. This is called dollar cost averaging, and it works really, really well. Over time, this approach has historically led to better returns than trying to time the market. And it's certainly better than taking money out during market crashes, which many people are doing right now, unfortunately, and for a lot of them, it will be the wrong move. Next, timing Roth conversions to maximize the impact. Moving money from a taxable account to a Roth account is smart if you do it during the right time. And the best time to do it is in a year where you have lower income to report. Since you're going to pay income tax on the amount that you withdraw anyway, doing it in a year where your tax rate's lower yields a better outcome when you redeploy the cash back into a Roth. Popular low-income windows include early withdrawal years before you start taking Social Security. If you're self-employed, years with business losses are a very good time to make the conversion. Also, if the market has come down, it's a good time to sell and then redeploy. And of course, a good strategy is to sell only a portion each year to defer the tax impact. You don't want to take a big tax hit in one single year. This strategy creates tax-free growth and withdrawals for the future. We've looked at a lot of different strategies here, and a lot of them might be perfect for you, but also know that some of them just don't apply, especially some of the high income strategies. For the vast majority of people watching this video, that's going to be a hard one. But out of the strategies we talked about, only a few apply to people with a tremendous amount of income. The others apply to everybody. So pick one or two that make the most sense for you. Even one or two can have a dramatic impact on your retirement situation in the future. If you like this video, check out that video, 10 bad assets that will make a retiree poor. This is Jeff Schmidt, and I will see you in that video right there.